Hey everyone, welcome back to the channel. It's Ben Morales, and today we are going to be showing how a properly structured home equity line of credit can be so advantageous to you and your finances. This process of the rapid payoff method will help you more quickly and efficiently pay off your debt. And it's actually going to serve as an emergency fund account, a place that you could tap into and leverage and do it relatively at a low cost. So I'm going to explain to you how I've been able to help this client so far. When we got together, they were about $12,000 in debt, and that debt was comprised of a little bit of credit cards and a little bit of personal loans. They did not have a debt tool in place, and so they are homeowners and they had enough equity in their home that they were able to finally get a hold of a home equity line of credit. So this is the information on their home equity line of credit. But in order to have this work for you, you have to change your mindset. So we have to change how bills are paid. We have to change where we leave our cash flow, right? So in this particular scenario, this couple has an income of $7,748. And from those $7,748, they have a total monthly expenses, $5,753. Now, what they were accustomed to doing is everything that they earned got put into their checking account at their bank. So they had one bank where the checking account was. They had another bank, or actually two more other banks for their credit cards. And then they had another bank where they had their savings account. And then they had the personal loans also that they had paid. So they had their cash flow distributed in many different places. So what we've done is we have consolidated to one financial institution where they're now going to be putting in their direct deposit into that new financial institution that gave them the approval for the home equity line of credit. Why do we do that? Because we're looking for efficiency, right? We want to be able to move money back and forth from that line of credit immediately in seconds. And when you have your home equity line of credit, and when you have your checking deposit account in the same financial institution, it's going to give you that leverage to be able to do so. So no longer are their funds all over the place. The only thing that they maintain was their current mortgage, which is $1,822 at a separate bank. They have a relatively low rate, 3.25, so we're going to head and keep that. But the rest of their debt is pretty much done. But now, this is why I always say it's not an issue of if, as it is an issue of when, right? When your home needs repairs, like it did here, right? Part of that debt that they incurred was because they had to replace windows at their home, and now they find themselves with another repair, right? So it's not if, but when your home needs repair, it's great to have a home equity line of credit to lean on. So that way you don't have to borrow and you don't have to charge anything into a credit card. The home equity line of credit is going to serve for that. So we're no longer leaving our funds in the checking account. We're actually going to leverage the debt to the home equity line of credit. And I'm going to show you why that flexibility of being able to move money back and forth is so important. So having your checking and the home equity line credit, the same institution is going to give you the ability to do this. They are essentially going to be moving, right? The $5,000 that they need to do the chimney repair is basically inside their home equity line of credit. So they can move that $5,000 from their home equity line of credit into their checking account. Now, the nice thing about that is that you can structure it in a way where you can move cash from your home equity line of credit when you have both your checking and the home equity line of credit in the same financial institution. You can do exactly this. Move money from your home equity line of credit into the checking account on the same day, which is what we're doing here, right? We have monthly expenses that they get, or rather a cash flow that they're going to have available. They get paid every other week. So now, where is the income coming from? Well, from their income, $7,748, we are not going to be able to touch $1,822 because that is basically assigned to their mortgage, right? So we're not going to touch that particularly now. We're going to leverage this home equity line of credit to do the repairs that we need to do. So that means the difference between what we can't touch, the 1822, and what will be available in terms of income is going to be $5,926. But since this couple gets paid every other week, the true income on a biweekly basis is $2,963. So remember I said earlier, you can actually time when you pull cash out from your home equity line of credit, you can time it for that money to be moved out, go online, move the money to your checking account, and also make the payment of your cash flow into that line of credit. So that's what this is. 5,000 is actually being borrowed from the line of credit. Now they have $5,000 cash. Some might argue, well, if they're getting paid biweekly, well, why not just take the $2,963 and use it to pay for the chimney? Well, they would have to wait to earn the money or to save the money, which is what they were doing. If they saved $650 for the next 7 or 8 months, then they would have enough to do that repair. And unfortunately, here in Illinois, that would be wintertime. So that's not what they want to do. They want to be proactive and get this done immediately. So if they time it, $5,000 cash goes into their checking account. That influx of their income becomes a payment. So that means that on day one, the actual balance for that particular transaction of the $5,000 that they made is actually $2,037. So you see that they borrowed cash, they pulled it from the line, they made that payment because it's designed to do exactly that. Now, when they make that $2,963 payment, that cash that they put as a payment now becomes available for them to reuse once again. But in the meantime, their balance for that line of credit is going to be $2,037. Now, if we calculate interest costs at that moment, we know that for that moment, their interest costs are only 64 cents per day, even if it's at 11.50, right, 11.5%, because interest is calculated on an average daily balance when it comes to a line of credit. Now, what's going to happen? Well, they are no longer going to be using this checking account that they were using at the bank because they're going to be leveraging this debt tool, which is a home equity line of credit, for all of their expenses throughout the course of the month. Now, because they cannot charge the 1822 for the mortgage, or rather they don't want to touch that, if we look at their total expenses and remove their mortgage of 1822, what they have in chargeable expenses is $3,931. That means the gas for their vehicles. That means food. That means going out to eat. That means any recreational activity, any leisure activities, any type of payment can be made right from this home equity line of credit debt tool, because this home equity line of credit debt tool actually comes with a Visa card, and it's treated just as if it were a debit card. So as the month is going by, right, they started the month with this cash out transaction and the income went in, their true balance is 2037, and now the month is starting to happen. So they're going to have expenses, and we know that their total expenses is going to be 3,931. But that is on a 2-week basis, right? So let's say that from the beginning of the month, for the next 2 weeks, they're going to have $2,000 in expenses, right? They're not always going to go get groceries. The car is not always going to need gas. So those expenses can happen at any time during those 2 weeks. So if that was the case, if we add 2 weeks worth of expenses, that means the new balance now comes out to $4,037, right? So we're going to say that that's the high balance because 2 weeks passed, $2,000 expenses were added to that particular debt tool, which also is going to raise the per day expense interest cost to $1.27. So at the same time that that's happening, we have the other half of the income that's coming in, and we're going to apply that as a payment. So $2,963 of income is coming in. So essentially, you're making two payments to the home equity line of credit, which what that does is it brings the balance down once again to $1,074. And the interest cost also goes down again and starts to recalculate it on a per day basis. And that's 34 cents a day. This is how you properly manage debt. And like I say, if it's structured the right way, and if you have that flexibility of moving cash in and out in the same institution, this is exactly what you want to do. When you do that, you're going to see that the rest of your expenses has to come out, obviously, because this was only 2 weeks of expenses. You had income come in. Now you have the rest of the 2 weeks of expenses. That's going to total $1,931, right? You start $2,000 there. That's the balance of that, $1,931, which means that after those 2 weeks and the closing statement for that particular HELOC month is going to be $3,005, right? That's the new monthly balance at the end of that month. And the new charges for interest is 0.95 or 95 cents. But lo and behold, what happened throughout the course of the time? We're going to get another payment of income. $2,963 of income is coming in once again, which means that now we have to calculate what the new balance would be, $80 I forgot to mention that I included this here as interest, right? Because we calculated interest is $38.10. We could not calculate interest off of 64 because that was the low balance. We had expenses that brought our balance up to 4037. We could not calculate it off of this low balance because, again, we had to add in expenses once again. So I calculated the interest cost for that month at $4,037, and that's how I got the $38.10. That's where it brought up our new balance afterward. And once after these 2 weeks, that $2,963 goes in, our balance to start that particular month is going to be $80.10. And this is where we're going to be getting charged interest of 3 cents per day. This is a properly structured and an extremely efficient home equity line of credit. So if you need help setting this up, or if you need some consultation exactly where to look for, reach out to me. Put that down in the comments. Tell me what city you're in, what state you're in. I'll do my best to research this and try to find a good place for you that you could get something similar structured for you like we did for this particular client. So thanks again for tuning in and for all your support. Continue to like, subscribe, and share. Tell all your family and friends about this great method to pay off debt. And if there's any way that I could be of service for you, please contact me and let me know. So until the next video, take care and God bless.